Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alia Kristina binti Chiastri. My matrix number is 070066. So my group and I will present about Padini Holdings Berhad.
Assalamualaikum. My name is Nurisma Farsha Alia binti Muhammad Yusa and my number matric is 069098.
Assalamualaikum. My name is Nur Alia Shafika binti Sham. My matric number is 0718 and 17.
My name is Aiza binti Zaini. My matrix number is 071702.
Okay, now we move to introduction. From business scope side, trade of clothing and fashion item for men and women. Product include bags, accessory, shoes and clothing. Second is key brands. Number one is Vinci. That's most well-liked brand among women. Other brand is Sid, PDI, Mickey, P&Co and Vinci accessories. Okay, now we move to history. The founder is Mr. Yong Panchuan and that established Huayu Garment Manufacturing Company in 1971 in Malaysia. After that, the vision of Padini is to be the best fashion company ever. Focus on best value products, excellent shopping experiences, responsibility and sustainability, and aim to set industry standard to be a global leader. And the mission of Padini is exceed customers' expectation and brand promise, continuous innovation and improvement to better value, quality and satisfaction. And then, build trust and loyalty through consistent brand performance. And last is workforce and location. It have 5,000 employees and the main office in Hong Kong and Kuala Lumpur. And the last, it has 3,030 global location.
Next, I will explain about the analysis of company financial statement. This is under liquidity ratio. So to calculate current ratio, we have to make current asset divide by current liability. So the current ratio for Padini Holdings Berhad decreased on 2022, which show a bad sign which is not liquid. For example, on 2021, Padini Holdings Berhad have 5 ringgit 40 cent in current asset for every 1 ringgit of current liability. Then we move to the quick ratio or asset test ratio. The formula is current asset minus by inventory and then divide by current liability. The quick ratio of Padini Holdings Berhad decreased on 2022 because the company does not have sufficient current asset to cover its current liability outstanding in the short term entirely. Thus, the company also has lower inventory turnover and cash conversion cycle. After that, we move to the net working capital. The formula is total current asset minus by total current liability. Net working capital for Padini Holdings Berhad shows positive value. That means the company has enough current asset and money left over after paying its current liability. So it has enough to cover its short-term bills and has a balance of money to spend on growing its business. Next, we move further to the leverage ratio. First, we have to calculate the debt ratio, which is by formula total liability divide by total asset. Padini Holdings Berhad finance 37% of its asset with debt as of 2021. The company increased its debt ratio by 40% in 2022. So, it shows that the management of Padini Holdings Berhad may have made a deliberate financial choice to position the business in a way that will enable it to generate higher returns while taking on more risk if the debt ratio increases. For debt to equity ratio, we have to calculate total liability divide by common stock equity. The debt to equity ratio for Padini Holdings Berhad increased with time from 0.59 in 2021 to 0.68 in 2022. It should be noted that Padini Holdings Berhad has lower debt to equity ratio because there will likely to be a little return to shareholder because the debt is frequently lower than equity.
Now we will move to efficiency ratios. First is inventory turnover ratio. Inventory turnover ratio equal to cost of goods sold divided by average inventory. For 2021, inventory turnover ratio equal to 2.60 times and for 2022 equal to 4.56 times. Second is asset turnover ratio equal to net sales divided by average total assets. For 2021, asset turnover ratio equal to 0.77 times and for 2022 equal to 0.95 times. Third is receivable turnover ratio. You can get by dividing credit sales with average accounts receivable. For 2021 is 21.27 times and for 2022 is 25.34 times. Next is profitability ratios. First is gross profit margin equal to gross profit divided by sales and times with 100. For 2021, gross profit margin equal to 37.84% and for 2022 equal to 38.47%. Second is net profit margin, which can get by dividing net income with sales and times with 100. Net profit margin for Padini in 2021 is 5.25% and in 2022 is 11.16%. Third is return on asset equal to net income divided by assets and times with 100. Return on assets in 2021 is 4.24% and in 2022 is 10.31%. Fourth is return on equity, which equal to net income divided by shareholder equity and times with 100. Return on equity for Padini in 2021 is 6.74% and in 2022 is 17.29%. Next is return on investment, which equal to net income divided by cost of investment and times with 100. Return on investment for 2021 is 914.52% and for 2022 is 427.45%.
Padini's approach for selecting potential customer for financing is meticulous, driven by a commitment to efficiency and risk management. Central to this approach are the principle of good lending, which ensure that financing decisions are both strategic and beneficial in the long term. The 5 C's of credit serve as a systematic framework for evaluating potential borrowers. Firstly is character, creditworthiness. Padini evaluates the borrower's credit history, including the past payment behavior, delinquencies, and interaction with suppliers. This assessment provides insight into the borrower's reliability and the willingness to meet financial obligations. Secondly is capacity, ability to repay. Padini analyzes the borrower's capacity to repay the loan by assessing factors such as the cash flow, income stability, and existing financial commitments. This evaluation helps determine whether the borrower can manage additional debt responsibly. And third is capital, finance strength. Padini reviews the borrower's balance sheet to assess financial strength and stability. By examining equity and assets, Padini gauges the borrower's ability to withstand financial challenges and mitigate risks. And next is collateral, security. Padini may require collateral such as real estate or stocks to secure the loan. These collaterals serve as a safeguard for the lenders in the event of default, reducing the credit risk. And next is conditions. External factors. Padini considers external factors such as economic condition and regulatory changes that may impact the borrower's ability to repay the loan. This assessment helps mitigate risk and ensure sound lending decisions. Okay, now we move to the financial statement analysis. Padini conduct comprehensive analysis of the deeper borrower's financial statement to gain deeper insight into their financial health and performance. This analysis includes profitability analysis. Padini evaluates sales strength, profit margins, and net income to assess the borrower's profitability and revenue generation source. Understanding the borrower's profitability is essential for assessing their ability to generate income and repay the loan. And secondly is liquidity and solvency analysis. Padini examines liquidity ratios to assess the borrower's ability to meet short-term financial obligations. Additionally, solvency measures such as the interest coverage ratio and debt to equity ratio provide insight into the borrower's long-term financial stability. And Padini assess a borrower's creditworthiness and ability to repay loans through review process. This involves firstly is evaluating financial health, reviewing the client's balance sheets to ensure they are financially sound by examining their equity and assets. Second is identifying collateral, determining belongings the borrowers can use as collateral to guarantee the loan, which help reduce the lender's credit risk. This collateral may include real estate, stocks, and other personal assets. And third is assessing external conditions, considering external factors like economic conditions, market trends, and new laws that might affect the borrower's ability to repay the loan. Through this step, Padini aims to ensure that borrowers is capable of repaying the loan while minimizing the lender's risk.
Next, I will talk about recommendations regarding the loan application, including the amount, terms, and conditions. First is liquidity position and loan amount. Padini liquidity stands at 726,864,000, which indicates a strong financial base. This robust liquidity makes Padini is well positioned to support a loan application of 300 million. Second, recommended tenure and interest rate. We recommend a loan tenure of 5 to 7 years. This duration strikes a balance between manageable repayments and continued business growth. Additionally, it is crucial to negotiate for a fixed interest rate to protect against market fluctuations and ensure stability in financial planning. Third is collateral and financial convenience. Moving on to collateral and financial convenience, we propose pledging receivables and inventory as collateral. To safeguard financial health, Padini need to maintain a minimum current ratio of 31. Next, keep debt to equity ratio below 0.752 and reduce dividend payments to preserve earnings for debt repayment. Number 4 is repayment strategies. We have devised several approaches to ensure timely and efficient repayment. First, implement automatic deductions from business bank account. Second, allocate a specific percentage of business earnings for loan repayment. Third, we will practice effective cash flow management and maintain an emergency fund. Finally, conduct regular financial monitoring and quarterly reporting to assess performance and compliance with loan conditions.
So for conclusion, I will give more explanation based on the analysis of financial statement that I stated previously. So to sum up, Padini Holdings Berhad also provide a sound foundation to seek the loan, and the financial analysis together with a management plan demonstrate that the company has strong liquidity position as well as effective management of financial debt. Then, Padini Holdings Berhad also has the opportunity to manage the most vital feature of the credit, such as the 5 C's of credit: character, capacity, capital, collateral, and condition, and evaluating the company financial statement. So, I will continue about more explanation on the analysis of company financial statement. Based on ratio analysis, Padini Holdings Berhad have 5 ringgit 40 cent in current asset for every 1 ringgit of current liability. This could cause investor to become concerned about the company liquidity risk and the possibility that there won't be enough liquid asset to cover the company's short-term financial obligation. Meanwhile, for the quick ratio of Padini Holdings Berhad decreased on 2022 because the company does not have sufficient current asset to cover its current liability outstanding in the short term entirely. This is because the company was experiencing slower converting receivable into cash and not able to cover its financial obligation. As an information, the quick ratio provides a better measure of overall liquidity only when a firm inventory cannot be easily converted into cash except during emergency. For the net working capital, Padini Holding Berhad has enough money to cover its short-term bills and has balance of money to spend on growing its business. In the other word, the company are healthy and can fund for future operation and growth. A positive net working capital also suggests that the company is more prepared to manage unforeseen costs and make investment in expansion prospect, perhaps increasing its appeal to potential investor. Then, for the debt ratio, Padini Holdings Berhad financed 37% of its asset with debt as of 2021 to calculate debt ratio. This show a better debt ratio than the previous year. Considering that a higher debt ratio indicates a greater reliance on borrowed fund, this indicates an increased financial risk. To make sure the company can pay its debt, bank may examine its debt ratio more carefully. The debt to equity ratio, it shows that Padini Holdings Berhad increased with time from 0.59 in 2021 to 0.68 in 2022. Higher debt to equity ratio reflect a trade-off, specifically that higher debt increases risk and return. Therefore, it is obvious whether a company has too much or too little debt, with the possible exception of when the debt is so large that the company is unable to pay it off. Furthermore, a higher debt to equity ratio could represent greater default risk, leading leading lender to evaluate the firm interest coverage to determine its ability to satisfactorily pay interest on loan. Next, I will continue about inventory turnover ratio. Inventory turnover ratio shows how effectively the firm sold its inventory and replaced it in a given period. For Padini, this ratio was almost 2.60 times in 2021 and enhanced compared to previous year when it reached only 4.56 times in 2022. That shows that Padini has stock rotation efficiency at a higher level, indicating that it learned to sell and restock faster. For asset turnover ratio, it determines how effectively a firm utilizes its asset to generate its revenue. In the same regard, the asset turnover ratio for Padini was advanced from 0. They purchased it 77 times in the year 2021, but later they bought it 95 times in 2022. Thus, it enhanced the efficiency on the use of the asset in the making of revenue. For the receivable turnover ratio, it evaluates the ability of the company to recover account receivable. As for the liquid position of Padini, the receivable turnover ratio is 21.27 in 2021 and 25.34 times in 2022. This shows that Padini enhanced its effectiveness on payment realization, thereby increase the efficiency on cash flow collection. For the gross profit margin, it represents how much of the revenue is left after the cost of product is excluded. For Padini, the gross profit margin was 37.84% in 2021 and marginally higher at 38.47% in 2022, signify reasonably stable and slightly better operating margin from its operation. Next, for the net profit margin, it shows the proportion of net profit or net earnings out of the total revenue earned. The company net profit margin was 5.25%, but in 2022, it increased to 11.68%, showing its improvement in Padini profitability status. Subsequently, on return on asset, it shows the ability of the firm to display its asset in generating profit. From the above tabular record, it can be ascertained that Padini's ROA is 4.24% and 10.31% in 2022. It shows an improvement in the efficient use of assets. For the return on equity, this formula calculates the return that have been achieved on the shareholder investment. For the year end 2021, Padini's ROE was 6.74%. This improved to 17.29% in 2022, demonstrate good progress in the overall profitability of the business in relation to shareholder equity. For the return on investment, it calculates the return on a particular investment, which is Padini's ROI was exceptionally high at 914.52% in 2021, decreased to 427.45% in 2022. Despite the decrease, the ROI remains significantly high, suggests excellent return on investment. That is all from us. Thank you.
Audio Jungle.